right, let's dive into the second part of our daily podcast into the case of Elad and Guy, loan 1367. Why reusing appraisals can slow down instead of speeding up, and standard DSCR closing timeline explained. All right, so let's hear a discussion.
For anyone looking at the U.S. property market.
That's right. We're talking about real estate financing, specifically for foreign nationals, but also for residents too.
And we're basing this on a pretty insightful discussion from Nadlan Capital Group.
The big question here, the one we really want to unpack, is what are those critical things you need to know? And maybe more importantly, what are the potential traps when you're trying to get financing for U.S. property, especially if you're not living here?
Exactly. We've got some great material, including a really detailed case study from Nadlan that honestly shows how things work on the ground.
Yeah, it's quite revealing.
So, our mission for you today is to cut through some of the complexity. We want you walking away with a clearer picture and some really practical knowledge about the whole thing.
Okay, so where should we start? That case study sounds like a good place.
Let's do it. So, this involves two individuals, Elad and Guy. They were trying to refinance four properties they owned over in Indiana.
And the main driver
Two
for them was
individuals,
speed.
Elad and Guy.
They needed
They
it
were
done
trying
fast
to
within 3 weeks,
refinance four
aiming for the end
properties
of
they owned
May.
over in
And they
Indiana.
wanted cash out too.
Right, cash out refinance. And their plan to make this happen quickly, well, it involved reusing appraisals that were already done for a different lender.
On the face of it, you can see why they'd think that. Seems efficient, doesn't it? Get the appraisals, pass them on, job done faster.
Yeah, like a shortcut. But is it really? What's the catch with just reusing old appraisals?
Well, that's the core issue here. It sounds like a time saver, but it often isn't the fast track people imagine. For one thing, the appraisal actually needs to be formally reassigned to the new lender.
Ah, okay. So it's not just forwarding an email, there's paperwork involved.
Exactly. It's an official process, and that alone can take, several days to sort out.
Okay, several days just for the reassignment. What happens after that?
Then, even when the new lender gets that reassigned appraisal, they don't just rubber stamp it. They have to do their own internal review.
Makes sense. They have their own rules, their own risk levels.
Precisely. They need to make sure it fits their underwriting standards, their specific requirements. So you're essentially restarting a chunk of the underwriting process anyway.
Got it. So the shortcut isn't quite cutting out as much as you'd hope. Are there other things that can trip you up with transferred appraisals?
Oh, definitely. You often have delays because of outdated information. Maybe the flood zone data isn't current, or there's missing info about the title policy.
Little details that are actually crucial for the lender.
Absolutely critical. And if that stuff isn't up to date or easy to find, it just puts the brakes on the whole underwriting train.
So going back to Elad and Guy, they had these appraisals ready around May 1st. But just a few days later, maybe May 5th, the lender basically told them, look, that 2-week closing, not happening.
Yeah, that must have been tough news. It really throws into sharp relief the gap between what a borrower might want and what's, well, typical for these kinds of loans.
These are often DSCR loans, right? Debt service
Yeah.
coverage ratio.
That's the one. And for most DSCR refi deals, you're generally looking at realistically 45 to 60 days to close.
Wow, okay. 45 to 60 days versus the 3 weeks they were hoping for. That's quite a difference.
It is.
So, apart from just the appraisal side of things, what are the maybe two or three biggest things that stretch out that timeline? What should people be ready for?
Well, a big one is just coordinating all the documents with the title company. There's a surprising amount of paperwork they need to gather and check.
Okay, title company coordination. What else?
Then there's insurance, verifying the coverage, sometimes needing changes to the policies like DP1 or DP3 policies.
Those are different types of landlord insurance policies, right?
Right, with different coverage levels. Getting that finalized and documented takes time.
And does the way the property is owned matter? Like if it's in an LLC or something?
Absolutely. Entity paperwork can cause hiccups. Say, if you need a new EIN for new LLC, that's the tax ID number, sometimes there are just bureaucratic delays in getting that sorted.
Right. More potential holdups.
And then, of course, you have the lender's own internal rhythm. The actual underwriting review, the appraisal review, even if transferred, it's still reviewed, and then finally issuing the official loan terms. All that takes time.
It sounds like a whole chain reaction where one delay can easily ripple through. You mentioned Nadlan Capital Group had a quote about this.
Yes, it was pretty blunt, actually. Something like, We aren't hard money lenders. We can't just skip these steps. It's much better to underpromise and overdeliver than to make promises we know we can't keep.
That really hits home. It's about managing expectations, building trust.
Totally. Transparency from the start is key.
The case study mentioned a joint call happened. What went down in that conversation?
Well, understandably, Guy was frustrated. He felt there were delays and maybe not enough updates on what was happening.
Yeah, being left in the dark is stressful when money's on the line.
Definitely. And Eli chimed in, asking for the lender to be a bit more proactive with communication, keeping them in the loop.
So they voiced their concerns. How did Nadlan Capital and the lender respond?
Nadlon used it as a chance to, gently reinforce the reality of the timelines. They even suggested maybe pushing back whatever Elad and Guy needed the funds for, maybe into June, to align with a more realistic closing date.
Practical advice. And the lender. Did they acknowledge the appraisal situation?
The lender basically confirmed, yes, they could accept the transferred appraisals, assuming the reassignment was done properly. But they were quite firm that the original 3-week closing idea just wasn't feasible with their standard process.
So no magic wand, even with the appraisals.
Right. They did say, look, it might still be faster than ordering brand new appraisals from scratch, but it wasn't going to shave off, weeks and weeks. The
Hmm.
savings wouldn't be dramatic.
Okay, so everyone's on the same page now, timeline wise. What happened next? Nadlin laid out some options for Elad and Guy.
Yeah, they presented a few paths forward. Option one was basically
Hmm.
stick with the current lender hashtag 2494, aim for a closing maybe mid to late June.
And the logic there.
The logic was that this lender, despite the timeline adjustment, still had the strongest overall terms on offer. And importantly, they knew what they were doing with these kinds of deals. Experience counts.
Okay, the steady but slower path. What was option two?
Option two was to go back and look at offers from two other lenders who had shown interest earlier.
Hmm. Revisit other possibilities.
Eh,
Any downside?
Well, Nadlin warned them that switching lenders at this stage would almost certainly mean even longer closing times. Plus, there was a risk those other lenders might reprice their offers now that the closing date had shifted. Rates change, markets change.
Right. So potentially more delays and maybe worse terms. Not great. Was there a third option?
The third option was more of an emergency lever, really. Consider a bridge loan or maybe hard money financing.
Ah, the faster, more expensive money.
Exactly. This was positioned as, look, if you absolutely need these funds urgently for some other commitment, this is a route. But be prepared for significantly higher interest rates and fees. It's short-term costly financing.
So Nadlin really mapped it out for them. The most likely path, the potentially riskier path, and the expensive emergency path.
Yeah, giving them the full picture, the pros and cons of each, which honestly is what you want from an advisor.
Definitely. And this whole story, Elad and Guy's experience, it really crystallizes some key lessons, doesn't it, for anyone looking at US real estate financing?
Absolutely. There are some big takeaways here.
Okay, let's nail this down. What's the number one lesson you think people should take from this?
I think the first thing is just busting that myth about transferring appraisals. It is not a guaranteed super fast solution. It might save some time, maybe, but it doesn't bypass the lender's own process.
Right. Don't bank on it being a magic bullet for speed. What else?
Second, get real about timelines. For these DSCR loans, you absolutely need to plan for bare minimum, probably 30 to 40 days. But more realistically, be ready for that 45 to 60-day window we talked about.
So build that buffer into your plans from the get go. Crucial. Anything else?
Transparency. It works both ways. Lenders should be clear, but borrowers also need to understand it's a complex process with lots of steps, lots of people involved. Good communication avoids frustration.
Builds trust, manages expectations. Makes sense.
And finally, I think Elad and Guy's situation just shows you have to work with the lender's process. Even if you're really motivated, there often aren't shortcuts around the standard procedures. Pushing too hard against the system usually doesn't end well.
Valuable points, all of them. It sounds like navigating this is where a group like Nadlan Capital really comes in. Can you tell us a bit more about what they actually do, broadly speaking?
Sure. So Nadlan Capital Group positions itself as a financing advisory firm, but also a referral marketplace. Essentially, they help investors figure out the financing maze for U.S. real estate.
And what kind of financing are we talking about?
All sorts, really. Standard property purchases, refinance deals like Elad and Guys with cash out, loans for renovations, new construction projects, financing for multifamily buildings, and even, interestingly, for short-term rental properties.
And a key point, especially for some of our listeners, is that they work with foreign nationals, right? even without a U.S. credit score or social security number.
That's a big part of their service, yes. They stress that they provide personalized guidance and connect investors, both US based and international, with a really wide network of lenders.
Sound useful. They mentioned something about an auction.
Yeah, they describe their process as creating an auction between hundreds of banks. The idea is to make lenders compete, basically, to get the client the best possible loan terms.
An auction. I like the sound of that for the borrower. Do they help with other things besides just the loan itself?
They do. They also mention assisting with some of the foundational stuff, especially for foreign investors, like helping set up US bank accounts or forming US companies, LLCs, and such. Things you often need to structure your investment properly.
Okay, so quite a full service approach, helping people get set up and then finding the funding.
Seems to be the goal.
Did the Nadlan discussion mention any specific investment areas they're seeing activity in right now?
They touched on it briefly, mentioned things like um, new construction opportunities down in Florida, multifamily investments, which are always popular, and also the short-term rental market, pointing to areas like Miami as being hot.
Just examples of the kinds of deals they help finance, I suppose.
Exactly. Shows the range of what investors they work with are looking at.
So it really sounds like they aim to support investors right through the process, from spotting an opportunity to actually getting the keys funded.
Yeah, that seems to be the model. A comprehensive resource for people wanting to get into the US property market.
Well, this has been incredibly helpful. A real deep dive into the nuts and bolts of US real estate financing. That case study especially highlighted the reality of DSCR loan timelines and uh, the truth about appraisal transfers.
Definitely. It underscores how crucial it is to manage expectations, understand the lender's process. It's not always as simple as we'd hope.
Communication and realistic timelines seem paramount. You really need that transparency.
Couldn't agree more. Elad and Guy's story is a great practical lesson in that.
Which brings us to our final thought for you listening in. Thinking about all these moving parts, the potential delays, the lender requirements, what are some concrete, proactive steps you can take right now to make your own financing journey smoother, whether you're investing from overseas or right here in the US? Something to think about.
Definitely worth considering before we jump in.
Thanks for joining us for this deep.
All right. Okay. All right. And now, just before we are finishing this broadcast, we promised you an update about the Idaho market. So let's jump right in. Let's look at some data. And we want to remind you, we are getting updates on all 50 states in our Nadlan social network. For investors, you're going to get daily updates on every state, on lending, on mortgages, on stocks, crypto, AI, all of that, and more than 200 experts that you can consult with. So let's take a deep dive. All right. So first of all, the market trends and the property values. Average home value in Idaho. Okay, we know that Boise, Idaho went crazy during COVID. Prices went up a lot. It became kind of like a bubble, just like Austin. And then a lot of companies mentioned to the staff, listen, you need to come back home. So average home value in Idaho has increased by 2.4% over the past year. Median home prices in Boise rose from 635,000 to 650 in January 2025. So we do see appreciation. 1,322 homes in the other county inventory levels rose by 22%. So inventory rose, but we still see prices going up, but that's in Boise. And in Canyon County, experienced a 35% increase in active listings. All right, so we see more listing coming on. All right, so let's look at the DSCR financing gains and tractions in Idaho. All right, so we can see mortgage rates stabilized between 6.5% to 7%. Idaho investors turning to DSCR financing for income-generating properties. DSCR financing assesses property's rental income relative to debt obligations, investors qualify based on the property's cash flow rather than personal income. So, appealing to self employed individuals, foreign nationals, and those expanding rental portfolios, because you are limited with traditional FHA conventional loan to 10 loans per person. Appealing to self employed individuals and those expanding rental portfolios, flexible qualification criteria, right? No, not looking at your taxes and your income. So, this is great. And you can also be a foreign national. Offers accessibility to a range of investment strategies. So let's look at the outlook for Idaho for 2025. The Idaho real estate market is expected to remain robust throughout 2025. Home prices continuing to rise modestly, inventory levels increasing, opportunities for investors utilizing DSCR financing, and capitalize on the growing rental market in Idaho. What is the conclusion? Idaho's real estate market in 2025 offers a balanced mix of opportunity and stability. DSCR financing is playing a growing role in enabling investment focused buyers to scale their property portfolio without relying on traditional income verification. As the market matures, this financing approach is expected to become even more relevant. All right, so for more information, visit our social network, of course, and let's jump right into Idaho and look at the numbers. We can see that prices are going down. Let's look at some statistics. The sale inventory growth year over year. We can see that last year we had 5,699 available properties for sale, and now it's grew by 18% to 6,774. Let's see how many price cuts. So, what is a price cut? All of the listings that basically people are trying to sell on the MLS, they cannot sell them, so they have to cut the prices. 20% of the listings see price cuts. Let's see the days on market. The days on market is actually lower. It was 42. Yeah, it went up a bit, 42 last year, now it's 44. But we can see that in April 22 to 23, it doubled. So now it's actually went down. Median listing prices year over year from 573,000 to 579,000, increase of 1.16%. New listing count. We can see an increase in new listing in 11.24%. Let's look at the demographic, population growth. We see an increase of 1.3%. Poverty rate, 9.4%. And let's see the vacancy. We have 10% vacancy. Let's look at the forecast. So the forecast is 43. So if 50 is balanced, 43 means prices are going down a bit. Not too crazy, but they are going down. All right, guys. Thank you for joining us for this update about some test cases of DSCR loans and, of course, drilling down into the Idaho market. Thank you for being with us today. And we are going to see you in the next update. Thank you. And see you soon.